Investing is how the rich get richer, but it's also how you can build wealth too. The problem, most people think it's complicated, risky, or just not for them. But what if I told you that with just 6 steps, you could start investing today, even if you have zero experience? Stick with me and I will break it all down step by step. So imagine this, it's 10 years from now, and you run into two old friends, Jake and Sam. Back in 2025, both of them were making the same salary, have similar expenses, and were just starting their financial journey. Fast forward to today, and Jake has built a solid investment portfolio worth hundreds of thousands of dollars, while Sam is still living paycheck to paycheck, wondering where all his money went. What made the difference? Jake started investing early, while Sam kept putting it off, thinking he needed a lot of money or just that it was too complicated. Today, I'm going to show you how to be like Jake, how to start investing in Canada, step by step, even if you are a total beginner. Most people will go for a high interest savings account, but a high interest savings account might protect your money from inflation, but it won't make you wealthy. If you truly want to build long-term wealth and financial freedom, investing is the way to go. But let's be real, investing can feel intimidating, especially when you hear terms like stocks, dividends, and even assets allocation. That's why in this video, I will break it down into 6 simple steps to get you started on your investment journey. You will learn how to prepare your finances, take advantage of tax benefits, decide whether you need help, choose what to invest in, budget for investing, and maintain your portfolio over time. So stick with me till the end and you will walk away with a clear roadmap to start investing with confidence. Step number 1, I would say, make sure you are ready to invest. Before you start investing, you need to make sure your financial foundation is solid. Investing carries risks, and the last thing you want is to pull your money out of your investment because you weren't financially prepared. The two most important things to tackle first are high interest debts and emergency savings. Otherwise, I would say investing might hurt you more than it helps if you don't get these things right in the first place. So before you can put a single dollar into the stock market, real estate, or even crypto, you need to build a strong financial foundation. Why? Because investing comes with risks, and you do not want to be in a position where you need to cash out your investment early due to financial trouble. So now that you've made a decision to start investing, the first thing you are going to do is make sure you pay off your high interest debt first. Imagine investing in the stock market that gives you a 10% return per year. Sounds great, right? But if you are carrying a credit card balance at 20% interest, you are losing money faster than you are actually making it. So before you start investing, pay off those high interest debts that you have sitting there. If you have a credit card debt, that's your first priority. In Canada, the average credit card interest rate is over 20%, whilst the stock market historically average return is between 8 to 10% per year. This means your debt is costing you way more than you could realistically earn through even investing if you decide to go to the stock market. So let's say you invest $1,000 because you have $1,000 that you want to invest into the stock market and earns about 10%. That's about $100 in a year. But if you have that $1,000 in credit card debt at 20% interest rate, you are actually paying $200 in interest. You are already in the negative before you even begin. So before you start investing, pay off all those high interest debts first. Now, after paying off those high interest debts, the next thing you need to do is build an emergency fund. Life happens, you might lose your job, your car breaks down, or you get hit with an unexpected bill. In Canada, a good rule of thumb is to have between 3 to 6 months worth of living expenses saved in high interest savings accounts like maybe EQ Bank or even Tangerine. This prevents you from having to sell your investment when you need cash, because once you've paid off high interest debt and you saved an emergency fund, you are now ready to start investing. Step number 2, I would say use tax advantage accounts first. Why pay more tax than you have to? As much as we all love to pay tax, I always say, if possible, maximize all the advantages that you can use to reduce your tax burden. Because as much as we want to pay more tax, it might be in your best interest to find ways and means to reduce it realistically. That's what the rich people are doing. So why not do the same? In Canada, the government gives us some amazing tools to grow our investment tax-free or even tax-deferred. You need to take advantage of this before investing in regular taxable accounts. In Canada, we have 2 amazing tax advantage accounts that help you grow your investment faster. The first one is the TFSA, that's the tax-free savings account, and there is the RRSP, that's a registered retirement savings plan. These accounts allow your money to grow tax-free or tax-deferred, which means more of your profits stay in your pocket instead of going to the government. With the TFSA, you contribute after tax dollars, and any investment gains, dividends, or even withdrawals are completely tax-free. That means if you invest $10,000 today and it grows to $50,000 over time, you don't owe a single penny in taxes when you withdraw that money. This makes the TFSA an excellent choice for both short-term and long-term investing. However, there are yearly contribution limits. In 2025, it is expected to be around $7,000. And if you over contribute, you will face penalties. So be mindful of your limits. Every Canadian over the age of 18 gets TFSA contribution room. That was around $7,000 in 2020. And don't quote me on this. You can check your CRA profile to see how much limits that you have for yourself. Any money you make inside the TFSA is completely tax-free, and this is great for long-term investing like ETFs or even stocks. Then there is the RRSP, that's the registered retirement savings plan. The RRSP offers you lower tax today, pay later. The RRSP works differently. Your contribution reduces your taxable income, which can result in a nice tax refund. However, when you withdraw the money later in life, you will have to pay taxes on it. The goal here is to contribute while you are in a high tax bracket. That's when you are earning more, and withdraw when you are in a lower tax bracket. That's in retirement. So if your employer offers RRSP match, always contribute enough to get the full match. It is literally tax-free. And with the RRSP, like I said, your contributions will reduce your taxable income, meaning you are paying less taxes, and your money will grow tax-deferred until retirement. And this is best for people who are currently in a high tax bracket today, but will expect to be in a lower tax bracket when they retire. So it is always good to take advantage of it, because in that higher tax bracket, you are actually paying very high taxes. An example would be, let's say you contribute about $5,000 to your RSP and you are in the 30% tax brackets. You will get about $1,500 in tax refund, which you can reinvest or pay down on any debts that you might have. So now that you know where to invest, you need to decide how you are going to invest. Not everyone wants to spend hours researching stocks and investment strategies. That's where professional help can come in handy. And you have 2 main options. That's a robo-advisor or a financial advisor. The first option will be to do it yourself. And this one is best for people who enjoy learning about stocks, ETFs, or even market trends. And with this one, you can use platforms like Worth Simple Trade, Quest Trade, or even TD direct investing. All these are some platforms that you can use to do your own form of investment, and you can control everything yourself. So there's no fees, but more responsibility will now rely on you, because you are going to trust your own knowledge and information when it comes to investing. Then the second option is to go for a robo advisor. Robo advisors offers you hands-off investing. If you want to set it and forget it approach, then a robo advisor might be perfect for you. These are automated platforms like Wealthsimple or Questrade Portfolios in Canada that invest your money based on your goals and your risk tolerance. They basically will charge you a lower fees than a human advisor, but they don't provide personalized financial advice. This is a great option if you want a simple, low cost way to start investing. And with this one, is best for beginners who want an automated hands-off approach, because you have companies like Wealthsimple Invest and RBC Invest Ease who will handle your portfolio for you for a small fee, for about maybe around 0.5% per year. The third one is financial advisors, full service financial advisors. This one, they are offering you a personalized help. If you prefer a more personalized approach, a financial advisor can help you create a strategy based on your financial situation. However, they come at a cost. Some charge a percentage of your assets, sometimes between 1 to 2%, whilst others charge a flat fee. If you go this route, make sure you are working with a fiduciary advisor who is legally required to act in your best interests, not just sell you expensive investment products, because there are a lot of people out there who claim to be financial advisors, and all they are looking to do is just sell you expensive investment products so they can get their commission and walk away. With this option, is best for people who want a personalized finance plan, but watch out for those high fees and make sure you avoid advisors who charge over 1% or push expensive mutual fund. For most beginners, I would say robo advisors or low cost ETFs are the best way to start. Step number 4 will be choose what to invest in. This is where the fun actually begins. Now comes the fun part, choosing your investments. There are 5 asset classes. That's stocks, bonds, real estate, precious metals, and cryptocurrencies. And we are going to go through each one of them so you have an idea of what each one is. The first one is stocks. These have high growth potential. Stocks represent ownership in companies like Apple, Shopify, or RBC. Over the long term, stocks tend to outperform every other asset class, but they can be volatile in the very short term. The best way to reduce risk is to diversify by investing in index funds or ETF, which spread your money across hundreds of stocks instead of just one. Second one is bonds. They have stability and income. Bonds are essentially loans that you give to governments or corporations in exchange for regular interest payments. These are less risky than stocks, but also offer lower returns. If you want to reduce your risk, adding some bonds to your portfolio can help balance things out. Then third one is real estate. These are physical assets. Real estate can be a great investment, but it requires a lot of upfront capital and management. If you don't want to deal with tenants or maintenance, you can invest in REITs. That's Real Estate Investment Trust, which allows you to own real estate without actually buying property. Then last but not the least, we have cryptocurrency. These are high risk, high reward. Crypto like Bitcoin or Ethereum is a newer and more speculative asset class. It's extremely volatile, meaning the price can swing wildly. If you invest in crypto, make sure it's a small portion of your portfolio. Treat it like a high risk bet rather than a core investment. There are many different assets that you can invest in, each with pros and cons. Then step number 5, set your budget and automate it. Investing is not about timing the market, but the time in the market. A common question is, how much should I invest? The answer: start with what you can afford. Even $50 per month can grow into thousands over time with compound interest. The key is consistency. Set up automatic contribution so you invest without even thinking about it. So what I would advise is, start with whatever you can afford, even as small as it may be. It might just be enough. Just automate the contribution to your investment account. This removes the emotions and make it a habit. And just to give you an idea, if you invest about $500 in the S&P 500 starting at age 25, by age 65 you could just have had about $1.5 million. So by just investing that over a period of time, you can just become a millionaire. But that 500 might be nothing to you on a monthly basis. Then step 6, maintain and grow your portfolio. Investing isn't just a set it and forget it game. You need to check in at least once a year. Make sure your investments are performing well. Rebalance your portfolio if needed and adjust your strategy as your goals change. So my advice is, make sure you are just checking in at least once a year on those investments. But don't panic over daily market swings, because most people will end up be checking it on a daily basis, and as a result will just be panicking. Don't try to do that. If it's stocks that you are going for, just put the money in there and check in as and when that's needed. Don't be checking every day and start getting mood swings. And also, whilst you are checking, you can find ways to rebalance your portfolio. If your investment shifts too much, then also you can also try to increase your contribution as your income is growing. That way you can now increase how much you are putting towards those investments, increasing the capital that you have, making it more easier for you to grow faster. A typical example, if let's say stocks makes up about 80% of your portfolio, that's what maybe you want, and you find out by checking in that currently you are around 70%, you might need to maybe sell some stocks and buy more bonds to maintain your risk balance. Investing doesn't have to be complicated. Follow these 6 steps and you'll be very well on your way to financial freedom. And just before we go, a quick recap. 1, make sure you are financially ready. 2, use tax advantage accounts like TFSA and RSPs. 3, decide if you need an advisor or you want to use an robo advisor, or even whether you want to do it all by yourself. Then 4, choose your investments wisely. 5, set a budget and automate your contribution. Then 6, maintain and rebalance your portfolio over time. If this video helped you, don't forget to like, subscribe and comment below with your biggest takeaway. Next, watch this video on 11 reasons why the rich keep getting richer. I'll try and tag it up here if it's recorded. Your future self will thank you for investing today. Until the next video, cheers.